What's up guys, I'm Paul and welcome to the channel. So Vanguard is one of the UK's most popular platforms when it comes to investing because they market it as easy to use with low fees. But when you're just getting started, there are a few things you need to learn about the Vanguard platform. And that is why I decided to create this short beginner's guide to help you get started with Vanguard by looking at the accounts that they offer, the fees that they charge, and the investment options that are available. And I've created this video as the kind of video I wish I had had when I got started with Vanguard. So let's get started. So first off, let's look at the accounts that Vanguard offer. And for UK adults, which is what I'm going to focus on for this video, they offer three main options. The first one is the general investment account, and this doesn't offer any real tax advantages. It's their bog standard account. And depending on your personal circumstances, you may need to pay income tax on any dividends you receive. You may also need to pay any capital gains tax and any capital appreciation. So basically, if you sell your investments for more than what you bought them for. But there's no real tax advantages to having this account, and even Vanguard say themselves this is the account you should set up if you maximize the allowance in all of your other accounts. So let's talk about those other accounts. The second one they offer is the ISA, which stands for Individual Savings Account, and this is the most popular one that Vanguard offer. The reason is it's a really good tax wrapper. In fact, it's one of the best tax wrappers in the world because it allows you to invest up to £20,000 a year as of recording this video. This may change in the future depending on how the UK government decide to change things, but in an ISA you're not liable for any tax, so you don't pay any income tax on any dividends. You also don't pay any capital gains tax on capital appreciation, which is why it's a really effective tax wrapper. And also you have access to these funds whenever you need them. So if you need to withdraw it in 3 years time, you can do that. There's no time limit on your investments. And the third account that Vanguard offer is the SIP, which stands for Self-Invested Personal Pension, which is quite a mouthful, and I'm glad they abbreviated it to SIP. But this does offer some tax advantages similar to an ISA because it's free from any capital gains tax and also income tax as well. And you also get a tax relief on this as well at 20% if you're a basic rate taxpayer. And what this basically means is whatever you put in, the government will top that up by 20% up to £40,000 a year.
Nice.
Now, if you're a higher rate taxpayer, you can claim additional tax relief using a self-assessment tax return, which you need to submit every year. But I'd speak to an accountant about that before you go submitting it yourself. But there is one slight restriction with this. Because it's a pension, it means it is limited. You can't access the funds in this account until you reach the age of 55. So this is definitely a retirement fund, which kind of makes sense because it's a pension, obviously. But those are the three accounts that Vanguard offer, and it depends on you and your circumstances as to which one's going to be the best one for you. So next up, let's look at the fees that Vanguard charge, because they do charge a range of fees. The first one of these is the account fee, and this is set at 0.15%, capped at a maximum of £375 a year, which is the equivalent of having an investment portfolio worth £250,000. I'm nowhere near that yet, but it is capped at £250,000. So basically, if you've got any investments of more than £250,000, you're not paying this 0.15%. It's just on the first £250,000 you have invested. And this £250,000 is the total value of your investments with Vanguard. It's not per account, so it's not a £250,000 limit on your ISA, then a separate £250,000 on your SIP. It's the combined value of your Vanguard investments, no matter which account you've got them invested in. So for all of you ballers out there who've got massive portfolios, Vanguard might be an option that you want to consider. But for everyday Joes like me, that's a bit of a pipe dream at the moment. Now, the account fee is billed quarterly, and you will receive a notification, you will receive a document from Vanguard notifying you that they are charging you that fee, and they'll either take it from any cash you have sitting in your account, or if you don't have any cash in there or you don't put enough cash in to cover that, they'll actually sell off a small proportion of your portfolio to cover your account fees, but say these are billed quarterly. So the next lot of fees are all related to the funds that you invest in. And the first one of these is the OCF, or the ongoing charge figure. And this is the one that's most readily advertised across the Vanguard website. When you look at their list of funds, you'll see the ongoing charge figure mentioned. It's got its own separate column on their list of fund page. And this fee basically covers the day-to-day management expenses of running that fund. And depending on the fund you invest in, the fees can range from 0.06% up to 0.78%. So the second fee related to funds is the transaction cost, and this covers the cost of buying and selling assets within that fund, because whether it's equities or bonds, they are constantly making changes to their funds, buying different allocations, etc. And this fee covers the cost of buying and selling those. And once again, it depends on the fund you're invested in as to what the transaction fee is going to be, and with Vanguard it ranges from 0.02% to 0.79%. So the next two fees are just related to Vanguard's ETFs. And the first one is the one-off fee. And this is a fee that you pay whenever you buy or sell an ETF. And it ranges from 0.02% to 0.15%. And this fee basically covers the bid-offer spread whenever an ETF is bought or sold. Now, if you want to know more about bid-offer spreads and things like that, I'll leave a link to Investopedia's article in the description below, which explains that way better than I could. So if you want to learn more about that, go and check that link out on Investopedia. The second fee when it comes to ETFs is if you want to buy it at its live price. Now, I will cover this more when I talk about ETFs later in this video, but you can buy ETFs at their live price. And if you want to do that, you pay a one-off fee of £7.50. Or if you want to trade for free on ETFs, you can use Vanguard's bulk offer service, which trades twice a day and is the free option, which is the one that most people will probably go for because they prefer to have more money invested in their portfolio than paying it on fees. Now, when it comes to all of the fund charges, they are automatically taken from your investment portfolio and factored into your returns. You don't have to pay these separately like you do with the account fee. So let's talk about the funds that Vanguard offer. The first one I'm going to talk about is the Target Retirement Fund. And I think this is a pretty interesting fund, especially in the way it works, because this is a blended fund. It's blended between equities and bonds. And the way it works is Vanguard lays out a 5-year increments retirement period, so 2030, 35, 40, etc. And you choose the one that's closest to your target retirement date. So if you was planning on retiring in 2038, for example, you'd either choose 2035 or 2040. And what you do is you just invest your money every single month into this fund, and Vanguard automatically chooses the allocation between equities and bonds. And as you get close to your target retirement date, it starts moving your investments more towards bonds than equities, because bonds are seen as a more stable investment. So it automatically adjusts the allocation, so when you get close to retirement, you've got more bonds in your portfolio. But there is a bit of a trade-off for this, and this is you do get less control. So you don't get to choose when this allocation takes place. Vanguard chooses that one for you. So this means it's the most passive option that Vanguard offer when it comes to almost a managed fund, because you leave it up to them to change that allocation for you. You just basically put your money in every month and let them do what they're going to do. So the second set of funds we're going to talk about is Vanguard's Life Strategy Funds, which have been an incredibly popular hit here in the UK for Vanguard. And it's easy to see why, because basically investors choose a fund based on their risk profile. And there's 5 funds that Vanguard offer in their life strategy lineup. They start with the most risk averse option, which is the Vanguard Life Strategy 20, which is 80% bonds and 20% equities, up to the Life Strategy 100, which is the riskiest option, which is 100% equities. And basically you choose the fund that's based on the risk profile you feel most comfortable with. And say if you go for the Life Strategy 80, for example, this is 80% equities and 20% bonds. And you just invest in this every single month. And what people really like about these funds is they automatically rebalance your portfolio. So you'll keep that allocation of 80% equities and 20% bonds. Whereas if you're building your own custom portfolio, you have to do this rebalancing yourself. And this is something a lot of people like, is it's basically invest and forget, but it gives you more control over your portfolio than you get with the Target Retirement, because you're choosing the allocation, and you can also choose when, if you want to, decide to move between different funds. So if you're getting closer to your target retirement age, for example, and you want to go for a less risky option, you may want to move from, say, the Life Strategy 80 down to the Life Strategy 60. And you can do that yourself, and you choose when you make that change. It's not chosen for you like it is with the Target Retirement funds. So next up, let's talk about the funds that made Vanguard famous, which is the index fund. Now, if you're not sure what an index fund is, it's a fund that's designed to track a specific index. Now, these can be country-specific ones, such as the UK or the USA, up to global ones where basically you track every market around the world. It just depends on which market you want to be invested in as to which index fund you choose. And when it comes to index funds on Vanguard, you can choose ones that are equities, and you can also choose ones that are bonds as well. And it's up to you as the allocator allocation you choose if you want an allocation between equities and bonds. But unlike the Vanguard Life Strategy Fund, you need to manually rebalance these. So if you want a 90-10 split, you're going to have to work on it to make sure that you've got that 90-10 split, and you may need to rebalance it every 3 months, 6 months or year, depending on how often you want to do that rebalancing. But they do offer a good range of funds covering everything, as say, from country ones to global funds. Now, when you're looking at the list of index funds available on Vanguard, you may see ESG placed next to some of these funds. But what does this mean? And ESG stands for environmental, social and governance. And basically what this means is all of the companies that have been invested in that fund have matched Vanguard's guidelines for basically being ethical companies. So if you're an ethical investor, these may be the ones that you want to consider over the regular index funds that Vanguard offers. So next up is Vanguard's range of actively managed funds. And with these funds, all of the options within it, whether it's stocks or bonds, have been handpicked by Vanguard's team of investment analysts because they believe that these options are going to beat the market overall. But because it's actively managed, you are going to pay higher fees for this privilege. Now, whether you invest in these or not depends on whether you think Vanguard's team of investment analysts can consistently beat the market. Whether that happens or not, I'll leave that one up to you. Now, with all the funds I've just mentioned, there's a couple of things you need to know. The first one is you can buy these in one of two ways. You can buy them as an accumulation fund, which basically means your dividends are automatically reinvested in the fund, so you get that compounding effect. Or you can have a distribution fund, which means all of the dividends are actually paid out to you. Well, they're actually deposited in your cash section of your Vanguard account. And then you can choose what to do with them. You can either invest them yourself or decide to draw them off if you want to. But you do need to decide which one you want when you're choosing one of these funds. The second thing is you can buy them as fractional shares, which means if you want to just invest £100, you can invest £100. You don't have to buy complete units when you're buying any of these funds. You can just buy as much as you want in terms of monetary value. So finally, we come to Vanguard's ETFs, which stands for Exchange Traded Funds. Now, when you're looking at Vanguard's ETFs and also their index funds, they seem to do very similar things, but there are some subtle differences between the two. The first one is the way they're traded, because index funds are traded usually once the market has closed, and it depends when the cutoff time for that fund is and when you place the buy order, whether it's going to go through that day or the following day. ETFs, on the other hand, because they're traded live on the stock market, are traded much more frequently, and you can either choose to buy it at the live price and pay that one-off fee of £7.50, or you can use their bulk option trading, and they're still traded twice a day on that, and they're traded when the market's open. So you can trade much more frequently in the Vanguard ETFs than you can do with the Vanguard index funds. The second one is with Vanguard's ETFs, you can only have them as distribution. You can't buy accumulation ETFs. So basically any dividends that you get paid from these ETFs are deposited in the cash section of your Vanguard dashboard. And the reason is because of number 3, because with Vanguard, you can't buy fractional shares on their ETFs. You can only buy complete units. It's not like index funds or any of the other funds that Vanguard offers. You can't buy them as fractional shares. You can only buy complete units. So if you deposit £100 every month, you're probably not going to be able to invest that full £100 every month, because you'll submit a buy order with that £100 on an ETF, and it will buy the maximum number of units it can for the amount that you've submitted. You won't be able to invest that full £100. So that's the main difference between the ETFs and index funds that Vanguard offers. They do cover very similar indexes, but there are some subtle differences in the way they're traded. And it's going to be down to you which one is going to be best for you and your portfolio. So there you go, guys. There's a quick beginner's guide to Vanguard that hopefully has helped explain the platform in a little bit more detail and helped you understand a bit more what's involved when you're investing with Vanguard. If you have found this video helpful, a like would be absolutely awesome. Also, consider subscribing for more money related content. So thank you so much for watching, guys. I really do appreciate it. Stay awesome, and I'll see you in the next one.